Good afternoon, everybody. My name is Luis Santiago from Alumni Ventures Group. I wanted to just welcome and thank you for joining us for today's webinar. The webinar, I just want to let everybody know that it is being recorded. We're going to go through our materials here, and then we'll have a dedicated Q&A section at the end of the presentation. I would encourage you to submit your questions throughout the presentation, and just don't wait till the very end to submit them. Just submit them at any given point. I'll make sure that I curate those questions, and I will then toss them to our presenters today. Today, like I mentioned, my name is Luis Santiago. I'm Vice President of Community here, leading our fund marketing and operations. I'm also here joined by Anton Simunovic, our Chief Investment Officer. He leads our Office of Investments, which includes our investment strategy, our deal sourcing groups, and our portfolio services groups. And also joined by Alain Hanover, who's our Senior Partner for our Select Fund, and also the founding managing partner of our Castor Ventures, which is our fund specifically for the MIT alumni community. Today, as you can see the agenda, what we're trying to do here is we want to make sure that we seek to answer three key questions that most investors have when they're learning about our firm and our product offerings. Number one, why venture might be right for me is one of the questions we always get from our investors. The second question that we're seeking to answer here for everybody is what distinguishes a smart venture portfolio? And third, how does Alumni Ventures Group make venture investing smart and simple for me? So with that, I'm going to turn it over to Anton, who will take us through an overview of AVG and into our product offering.
Terrific. Thank you, Luis, and thank you everyone for making time today to learn more about Alumni Ventures Group. So it's been about 5 years at this point where AVG set out on a very important mission, and that was to make this important asset class called venture capital accessible to the individual. And we set about doing that in an easy and disciplined way. What started as a single fund based around our Dartmouth alumni community has now blossomed into more than 20 funds. And as you can see from the graphic on the right, AVG is now consistently one of the most active venture firms in the country. And we've had this success because we've never wavered on our core commitment to you, our investors, and that is to deliver a diversified portfolio of 30 to 40 high quality deals where we co-invest behind the leading venture capitalists in the country. So for the first time, the individual is now able to enjoy the same access and upside as professional money managers. And that's a big deal. So we want to give you all the white glove benefits of venture without any of the headaches. And what you'll see from this next slide is that having venture in your personal portfolio is quite important. This is something that the world's richest have known for some time. If you take Jeff Bezos of Amazon or Bill Gates of Microsoft, investing in a disciplined and thoughtful way in private companies is really smart. And the returns prove that out. If you look at the average historic 30-year annual returns of venture, they've been about 18%. That's more than twice what the public markets have delivered. And what we see here at AVG and what is becoming more common knowledge across the markets is that this disparity is likely to accelerate over time. And the reason is that the liquidity in our private and public markets is changing substantially. Successful companies today are staying private longer. In 1990, the US had about 7,400 publicly listed companies. By 2016, that number was cut in half. Between 1995 and the year 2000, about 500 companies went public each year. Today, well, I should say between 2012 and 2017, there were less than 25% of that number choosing to go public. And private companies stay private longer for two fundamental reasons. One, because they can. There's just more money available to private companies to help them grow. And secondly, because they want to. Wall Street, being public is challenging. Wall Street is notoriously short-term minded. It's stressful to run a public company. You need to deal with all the regulatory and disclosure hassles of being public. And so what that means is our most successful private companies stay private longer. Now, what does that mean for a private investor? You as a private investor are not enjoying all of that value creation while a private company stays private. If we were to take the case of Uber, now it's a good one to take, but if you look at Uber, which recently went public at a $70 billion valuation, as a public investor, the stock has been flat, arguably down. Had we been able to get in at a Series A or B round in an entity like Uber, we'd be up more than 1,000 times our money. Now that's an obvious and rich example for sure. I might add that AVG was a beneficiary of Uber going public. We invested in a company, gosh, maybe it was a year, 18 months ago, which I think Alain Hanover will chat with you a little bit more here shortly. But it was acquired by Uber. We chose to take some of our return in cash, the rest of it in equity and Uber equity. At this point, it's only been about a year, but we're up 6 times on that investment. And so the point is that there are different ways to play in the public securities, and it's important to have reasonable exposure to these securities. Conventional wisdom would suggest 5 to 15% of your investable assets should be in this asset class. And while it's prudent to have a disciplined approach to private company investing, it's also extremely challenging. It's near impossible today to get access to the best deals. It's even harder on the private side to know what constitutes a good deal. What you get in AVG is pattern recognition. We are experts at recognizing what good investments are. Private company investing is also very time intensive. To invest in a private entity means you need to understand its company, its management, the market opportunity, what the competitors are doing, the progress a company is making, how to even measure progress. AVG does all of this on your behalf, and we do it in a way that is both scalable and simple for you. Now, the way we make it easy for you is that there's a single check. There's one drawdown. We provide you with a timely K-1 when it comes time to file your tax returns, as you'd now be the beneficial, hold a beneficial interest in a fund. We will then invest your money over the course of a year to two in 30 diversified companies, and you will be able to transparently see and track their progress through your own AVG personalized portal. Meanwhile, AVG will take the next 10 years of that fund's life to look to add value to these private companies to help them grow. And we do all of this under an industry standard fee structure, which is comprised of a 2% annual management fee and a 20% carried interest. Now, what carried interest means is that when and if profits are generated in a given fund, we first pay you back the fees, and then we ratably share the profits. 80% goes to you, 20% goes to AVG. And this, again, this 2 and 20 structure is an industry standard. Just a few more words here on our investing approach. So we have, as mentioned, 20 funds. They're spread across 5 offices. We have 40 investment professionals, full-time investment professionals. It's important to emphasize that we are purely, co-investors. We never do more than 15% of a round. So this means that we never set valuation in a company. We never establish terms. We stay strictly value add to the company that we invest in and to the venture firm that is leading the deal. Now, this approach has allowed us to make 150, 200 investments per year. That's the pace at which we are presently investing. And we're able to source this terrific number of high quality deals because we have a very robust alumni network and individuals that are interested in what we're doing, presently numbered around 400,000 and growing at 25,000 per month. From this network, we see an incredible amount of deal flow. And within this community, we leverage an expert network that assists us both with diligence as well as adding value to our portfolio companies after an investment has been made. Another key feature that I want to distinguish with our approach is that our investment teams are highly collaborative. So we actively encourage our funds to assist one another, not only in diligence, but also in cross-investing in deals together. So what this means is that if you are an investor in one fund that's on the West Coast, let's take Spike, we actively encourage Spike to co-invest in East Coast deals and vice versa, which means that you are seeing the best of all deals across our national network. It's really, again, speaks to the power of AVG. We're also very process intensive, and each deal at AVG follows a rigorous screening, diligence, scoring, and evaluation process from 3 different layers. And those 3 layers are really the investment team itself, the investment committee that's around that investment team, and then ultimately the AVG Central Investment Committee. Key point is we move quickly, but we are highly disciplined and very systematic. And as mentioned earlier, we're strictly co-investors. So I wake up every day with one thought: how do we identify and invest in top quartile deals being led by top quartile venture capitalists? And our deal flow, again, comes from our network. It comes from our personal relationships that we have on the venture capital side, the CEOs of our portfolio companies, and the substantial proactive outreach that we have here at AVG. Each of the firms that you see listed here, we have invested behind. With conviction, I can tell you that it would be near impossible for an individual to invest either in or alongside these funds. And why is investing behind the leading VCs in the country so important? This slide really says it all. When you invest in the top quartile VCs, a disproportionate share of the returns come from those VCs relative to the bottom quartile. And this happens year after year. The best VCs invest in the best deal flow, the best entrepreneurs, want to be funded by the best VCs. It's a virtuous cycle that, again, as an individual with an investment in AVG, you'd have opportunity to enjoy. With that, let me hand the floor over to Alain Hanover, who is our senior partner and represents our Select Fund.
Hi, good afternoon, everyone, and good morning to those in California. Next slide, please. So a year ago, the AVG group decided that we really were missing out and were not serving alumni and others from outside our core schools. You can see on this slide, we have 14 core funds. We're actually adding 3 to 5 more schools this year. They're all codenamed because we can't use the school's name. We're not affiliated with the school. But you can guess, like, for example, the Yard is Harvard and Blue Ivy is Yale, Spike is Stanford, and others. And when you look these up on our website, you'll see the names of the schools mentioned clearly. And the Select Fund was formed to select a diversified portfolio from all the schools to put together companies that were in every industry, every geography, and at every stage, and that mirrored the U.S. distribution of venture deals being done. So you have a kind of index fund on the industry based on the investments done by our core teams. So as as Anton mentioned, we have investment teams for each of the core funds, and of course teams for the for the Select. Over 40 full-time professionals that are deal sourcing, evaluating deals, and they're backed up by investment committees in each of the funds. The Select Fund is pulling deals in a programmatic way to give you the diversity that we promise at a rate of about 1 to 3 deals per month. So you can see here, we started the Select Fund a year ago, and roughly for the 30 or so deals we've done so far, you can see the sectors, the variations in different sectors. Some are heavier than others, AI, robotics, healthcare, and the others are, smaller sectors, could energy and consumer, etc. In terms of stage, we have roughly a half our early, half our growth, and half our later stage, a quarter, or rather, each of later stage and growth stage. And then the geography comes from all the geographies. Of course, California, New York, and Massachusetts predominate, as they do the national numbers, and the other regions account for the remainder. So here are some sample companies that have been done in the past. And just to give you a little color for how these companies were invested in, let me take Compass, for example. Compass is a biotech company that's unlocking the complexity of the immune system with antibody therapies. The co-founder of the company went to Dartmouth and was contacted by our Dartmouth team, and has allowed the AVG to participate in multiple rounds due to the affinity for Dartmouth and the connection with our Dartmouth team. The company currently is advancing 15 therapeutic candidates for cancer, inflammatory, and autoimmune diseases through clinical trials. The middle one, Jump Bikes, provides electric bike sharing systems in dozens of cities across the world. Yard Ventures, the Harvard Fund, had a relationship with an executive that positioned us for an allocation in the next round of financing. They were experiencing great growth and tapping into a very large market. So we gained access, limited access to the next round that was being led by their premier investor, Menlo Ventures. And Menlo had a history of success in consumer and transportation companies, and they were an early investor in Uber. And then 6 months after our investment, Jump was acquired by Uber was published $200 million. And as Anton mentioned, we were issued both stock and cash, and so our investors got more than their money back initially in cash, and then have an upside in the Uber stock. The last one, SmartVid.io, is a company that's using computers with AI and machine learning to be a silent building inspector and policeman. They watch video feeds from building sites for violations of safety and building materials, etc. The founder was an MIT graduate, a serial entrepreneur, and had sold a previous company. And myself, the MIT managing partner, knew the CEO, and we talked. And when he had a round of financing, was pleased to invite Alumni Ventures in it. The reason is because we had a huge pool of alumni graduates who could be potential customers or potential employees for the company. They're always looking for top graduates to join the company. They were raising an A round with leading investors. Borealis and Autodesk also participated. And they also allowed the Alumni Ventures to syndicate it to our investors as well. So this one was syndicated. So these are examples of how we got into companies and have had success in acquiring the best investments from the best venture capitalists. So I'll now turn it back over to Luis to run the Q&A for you, and please send us some questions so we can tell you more.
Fantastic. Thank you so much, Alan. Thank you, Anton. As you both were kind of going through the material, got a number of different questions. So before we jump into the questions, I'm going to leave it on this slide. I think if anyone's interested and wants to connect with us, you could easily just follow up with us at this email address, community.relations@avgfunds.com. You could easily go to our website and start a chat with one of our community relations folks. Or just wait for a follow-up email, and all of the information will be in that, including a recording of this webinar, and a number of different next steps depending on how you choose to choose your journey. So this question is going to be for Anton. Anton, as you were talking, there was a lot of questions that came in from a couple gentlemen, Brian and Scott. Thank you for your questions around returns. So I want to start at the highest level. It's a kind of a three-part question, so I'll start with the first part. The first part of the question is, what are AVG's returns to date for our general performance?
So it's still early days, but happy to share with you some hard numbers. We've invested to date in about 300 different companies. We have had either a full write-down or a partial write-down, I believe, in 7 of those. We have had either exits or up rounds in 74 of, I think, the 308 that we've done to date as of the end of March. We're quite pleased with these results. There's a truism in venture where your poorest performing investments will surface first. Winners always take some time to develop, and typically across 4 to 7 years. It's still early in the life cycle of many of our funds, and so the initial indicators are fairly positive. We're tracking at a 1.6, 1.7 times total capital invested at this point, and we're feeling very good about our portfolio.
Fantastic, thank you for that. And Alan, I'm gonna jump to you right now. The question comes from Matt. His question is, does each school fund have different investments, or are the investments spread evenly across all school funds?
Yeah, so every school fund is roughly doing about 1 deal a month, and that 1 unique deal a month, roughly, and then they typically participate in 1 additional deal from another fund each month. So each school fund is doing about 2 deals a month total for their investors. And because there's a huge amount of overlap between schools represented on the management team, the school funds can invest in usually a deal typically has 3 to 6 schools participating, because no school discriminates against the other schools. They basically have management team that went to a lot of good schools, including those not represented in the core group.
Great. And Anton, I think, question now going back to you is, how, you talk about, this huge community, and CJ wants to know, how do you normally get into these deals?
Right, it's a great question. Everybody wants to get into these deals. Again, one of the things that really differentiates us is our community, the size of our community and the makeup of our community, because we have focused on alumni. Apologies, but from a lot of fancy schools, they tend to be a well-educated, well-heeled group that many of our portfolio companies have interest in having access to, and in a good way. I mean, not just wanting to sell, should it be a consumer deal into our community of 400,000, but rather many of them are in very attractive private and public companies across the country, and every private company is interested in incremental revenue, business development relationships, additional talent, PR. And so our community brings a certain panache to these companies that we invest in. That's one way. The other way is, to date, we have, as mentioned, 308 portfolio companies. That's 308 distinct CEOs, for the most part from these leading academic institutions. they too bring us very attractive deal flow. Ideally, we're looking to identify entrepreneurs that are on their second or third venture, and they tend to um, network with other successful operators. And so a lot of our deal flow comes from the CEO community itself. Finally, AVG proper, the investment professionals, most of us have spent our careers either directly in venture or in financial services or as primarily technology operators in the C-suites of various organizations. So we ourselves have fairly robust networks that we're able to tap and attract substantial deal flow to.
Great. So Anton, I'm going to stick with you. We've got got another question around deal sharing and allocation of deals amongst the different funds. Craig, thank you for your question. It's a great one. So the question is, there are multiple funds investing in a deal. Obviously, there are some that are not investing. Two-part question, I guess. How do you allocate the deal amongst the fund, or how do the alumni funds deal share amongst each other? And then on top of that, I think it'd be natural to go into how is a select fund collaborating and working with the alumni funds?
Sure. So on the allocation, and again, this really is something that differentiates AVG from a traditional venture fund, this notion that we're highly collaborative amongst our funds. So deals will be led by a given fund. To Alan's point earlier, let's say the Spike Fund out on the West Coast that is built around the Stanford community. They find an investment. We are very disciplined in portfolio construction. Again, these are essentially micro funds ranging in size from $5 to $15 million. We promise again to you to offer you a diversified portfolio, both by stage, sector, and geography, say 30 deals. It wouldn't be prudent for Spike to invest more than several percent of its assets under management in that given opportunity. Yet there might be the CEO of the portfolio company or the venture capitalist might be inviting us in for more than a $300,000 or $500,000 investment that Spike can make. We look therefore for other school connections on that senior management team, perhaps even on the board of directors of that company. And we then offer up and go through a very disciplined scoring process. It's left up to the decision ultimately of that sister fund as to whether they want to partake in the investment. But we, again, very methodically expose these attractive investment opportunities to our sister funds on those deals that they are not leading, which is therefore we often the case, minority, but 30, 40% of the time, we will have an investment that 2 or 3 of our funds might be a part of. Now, the way it comes to select, capital is select in some ways rides on top of all of our funds, all of our 20 funds. Capital is invested into select by select investors. And again, our promise to you is a diversified portfolio by stage, sector, and geography. Capital is raised on a quarterly basis, though it is deployed across a year. As Spike finds a deal, as Green D, affiliated with Dartmouth, finds it, Spike finds, let's say, a financial technology deal. Dartmouth is investing in a healthcare-related deal, Green D. MIT, Castor finds a autonomous vehicle deal that we recently invested in called Optimus Ride. We carefully construct the select portfolio, again, across a year, mimicking what the venture index is essentially doing. If venture across a vintage year is putting 5% into healthcare, we will look to put 5% of those select assets in that quarter into a healthcare derived technology. So in some ways, select mimics and mirrors the aggregate index of venture across the country. And it rides on top of all of our venture funds, essentially.
Alan, you mentioned a couple of deals that you highlighted that you really like. Is there any other deals that are more recent? You mentioned these are things that we've done in the past that you're excited about, that you can provide some color that you've done over the last few months.
Oh yes. So we've one of the ones that we've done in Select, and it also went to the engineers and some of the other focus funds as well, which also participate in a programmatic selection of companies, is Mighty Buildings, which is making three-dimensional studio apartments for using 3D printing, and printing, basically the building materials, and allowing people to construct a studio apartment for their kids in their backyards. So a lot of kids are moving back home, and so this is a growth business. That's one example. Another example that we invested in the Select Fund was we made an investment in Lily AI, which is a company that's helping the fashion industry pick the best fashions. Customers pick the best fashions available based on current trends and also their particular preferences and styles. So it helps clothing manufacturers address the needs of their customers in a better fashion using computer aids. Is that enough, Luis, or would you like me to continue?
No, that's great. I mean, that's great. I'm trying to look to see. There's a couple other questions. There's one question here that Alan, I think it'll be a question for you from Scott. I believe that this is what he's asking. What is the typical investment? I think it may not be the minimum investment for an investor, one of our LPs, but what is the range of investments that we generally look to write as AVG for a particular deal?
In a particular deal, AVG limits itself to 10% of an investment in a deal between all the funds, including our Select Fund, or $1 million. We don't want to be a majority investor. We want to be a minority investor, limiting ourselves to no more than 10%, because then we can slip into a deal without upsetting the other VCs. They don't feel that we're competitive with them. It's often very easy for the management to reserve a slice for us or to add us to a round. They very often, because we're often the last ones in the round, and they like having our community as potential customers or employees, then they'll add us to the round, and adding another 10% to the round is actually good for the company, because every company likes to have extra cash in the bank in case things don't go as well as they should.
Great. So I have one more question. I think that we'll hand that one over to Anton. Anton, the question for you is, I think it's a deal kind of velocity, investment velocity question. What percentage of capital is deployed after 1 year or 2 years? You gave a little bit of a range, and I think you alluded to it a little bit, but question from Michael. He wants to specifically know the answer to that.
So most of the so in any given fund, so Alumni Ventures Group operates funds, Select included, which are essentially vintage funds. And what that means is that we're looking to deploy most of the capital in less than 2 years. We really target 12 to 18 months to deploy that capital. And then, of course, we work with the portfolio companies as best we can in a systematic and scalable way to add value where we can via our network or otherwise to those companies over the life of the fund. The life of the fund lasts 10 years. The capital is deployed in the vast majority of cases between 1 year and 2.
Thank you for that. I'm just reading through some of the questions here. I think most of the questions have been answered thus far. A couple questions here are very specific things that I'm not sure can be answered on this, but I will promise that we will get back to some of those questions. I think they're very, very specific questions, and we will get back to those folks with those questions. I think it's been a great call. I think we've gone through a lot of material. And what I'd like to leave with everyone is, like I said, we will follow up this webinar with an email with the link to the recording. It'll also be posted on our website shortly. And so, you can go directly to avgfunds.com to our webinars section of that website in order to access a recording of this website. Or you can go straight directly through the link that I will share via email. We will also provide slides that'll be a little bit more detailed than the ones we've shared here to provide you with that kind of takeaway and that leave behind. And with that, I bid you a great afternoon, a great weekend, and thank you so much for joining us today.